Will we have founders that come and join us and say, I need to get funding like 500K in the bank in less than 30 days. If I do not get funded in 30 days, we are toast. I have no runway. What do you say to that?
I mean, if you can do it, you will have set the land speed record of funding, right? And listen, who would possibly come to us and say, I need funding someday, 6, 12 months, a year? Who doesn't need funding yesterday, right? It's the only time frame. It's just totally incompatible with how this actually works. And again, why would you know this?
Back in the day, we've had founders come in here, talk to investor 30 days, term sheet, and then in 30 days, funding hits the bank. I'm hearing it's 6 to 9 months right now. I'm still waiting on term sheets 6 to 9 months later for conversations with some of our founders.
If we were to break down into 3 categories, like what is driving a fundraising timeline, here's typically what I tend to see. So the first thing, obviously, is how long it takes to even get a hold of these investors and or pitch them. Think of like as fast as you could possibly contact the right number of investors, a week, 2 weeks. I mean, just the nature of contacting humans and then having to go through the pitch process and then having to go through the second pitch process. Like, if you did everything right, a month would be the least amount of time that could possibly take. And that's the fastest part. What do you think?
I think that it takes time to get the process going. So usually founders come, and what happens is they don't even know if their pitch deck's any good.
Right.
So you got to take a month to get your pitch deck up and running, probably another month to do research, another month to do outreach, and then you'll start having these meaningful conversations with investors.
Right. And even then, those are timely conversations. Those investors are going to make ones of investments per year. So the ones that they're going to invest in, they're going to spend some time on. They're going to need to do their diligence. They're going to need to ask a bunch of questions. They're going to have to get consensus within the group. That just takes time. And again, I think people think of this process akin to like a payday loan where I just go in and I come out with money. And again, no reason you would know this, right? Most people have never been through this. So I get it. But a realistic timeline for just phase 1 of 3 of getting out there, talking to investors, absorbing feedback, putting it back out there, 2 to 3 months if you do everything right. And again, everybody's like, well, I need money in a month. How could you possibly get money in a month if it would take you 2 to 3 months just to go through the process of having the conversations? And again, this is part of, where we educate folks.
Well, we live this every day. Like, we're watching thousands of founders go through this. So we have the data, but unfortunately founders come in and they're in a pressure cooker of a situation.
Of course.
They're right in there. They got tunnel vision. Like, I get it.
Yeah, no, it's not that we don't understand, but our job is to kind of just give them, a bit of an understanding of what actually works. But I think when we talk through it here and explain why these things take as long as they do, I think that's helpful. So the second part is once I've talked to investors, and let's say I'm fortunate enough that a few of them are actually interested in investing. Well, the next step is going to be going through diligence, where each of the investors, and you typically have a few, they all have to go through and ask questions. Now, sometimes one will take the lead and do most of the legwork, but it's not like no one else is asking questions. And so the back and forth with all those questions, getting people up to speed as to what the business is. And then remember, just because you go through all that battery of questions and all that diligence doesn't actually mean you'll get an investment. So you could spend 6-8 weeks with a single investor who at the end is like, I've got everything I need and I don't want to invest. Guess what? We just reset the whole timeline. And those things happen. So even in phase 2, you can get held up and reset. And it happens all the time.
Let's talk about the elephant in the room here and just put it right between the eyes. Back in my day when I was investing or I was GPing for a bunch of LPs or I was the scout or the analyst, if a founder came to me and said, we have 3 months runway,
right,
it's pretty much an automatic no.
Correct.
That's really what it comes down to, because there are reasons, and unless I'm going to be very predatory and do a crazy deal that's unfair for the founders because they need to get bailed out.
Right.
There are lots of things that I immediately start thinking when a founder tells me I have 3 months runway or I'm going to shut down.
Right. And look, given the fact that as an investor, Ed, you've got tons of other places to put your money, what about a sinking ship would be appealing to you? If somebody comes to you and says, you could put your money in 100 different places right now, But guess what? Ours is also a sinking ship. Why would that appeal to anybody?
It's like rearranging the chairs on the Titanic,
Yeah.
or painting a few or adding a few more chairs. That
Right.
ship is still going down.
Yeah.
That's immediately what we think, right?
Yeah.
Then what I tell founders here at Startups.com is that if you've got a short runway, seeking investors is not going to bail you out anyway. Let's start focusing on, and this is what I got from our colleague Ryan, what's your plan B? And if you don't have a plan B, your plan A is not going to work anyway. What are you going to do if you don't get an investor in the next 30 to 90 days? What are you telling founders?
Look, okay, so we always, recommend a parallel path. We say, look, fundraising is a path. It's not the path. There always has to be two paths. There is fundraising as, hey, if that works out great, then great, we follow that. But then there's the actual plan of what we're going to do regardless of whether we raise money. I hear from a lot of founders, they say to me, hey, should I be building the business or raising money? And I said, both. And now, while fundraising is a huge distraction, but you can't do that at the expense of running your business. And frankly, if you stop growing the business, the probability of fundraising goes down anyway. So you've got to do both. It's hard, but you've got to do both.
And as an investor, that's what I like to see in a founder that has this absolute determination that if I don't raise a single dollar, I'm going to make this work anyway because I've got a path to revenue. I'm going to go consult. I'm going to find all these alternative ways to bootstrap my way to glory, then sit here and go, I need you or else I'm dead.
And it shows in the pitch. The founders that bring full desperation, it shows in the pitch. And again, as an investor, given the fact that you have countless options, investing in folks that look like they're desperate usually is a red flag. Right now, to be fair, every startup's desperate. It's the nature of building a startup. There's no startup out there that just got started and they're like, I just can't believe how much money I'm making, right? They're all in a position where they're in the negative. So they're all needy to an extent. Desperate means if I don't take this investment or if I don't get an investor, I have no hope. And ironically, no one wants to invest in a company that has that outcome.
Okay, I'm going to come clean then. I can see this coming a mile away because, and I'm not saying this is a bad thing. I understand emotions run hot, but we often have founders come in and sort of start to blame us that we're not helping them raise in 30 days. And the emotions leak out onto us.
Yeah.
And that's one of the things I look at that I go, this is going to come across to the investors.
Yes.
If you're getting hot and intense with me and you're giving me the runaround, then what are you going to do in front of an investor?
Right. And that's the thing. A lot of folks don't know what to expect. Most of the folks at Startups.com that we see are first-time founders. We do have serial founders. We also have serial founders who've never raised before. I was one of them. My first couple companies were all bootstrapped. So when I went to my fourth company and I was raising for the first time, I was so unprepared for how this whole process works. So again, we get it. But the frustration comes from the fact that regardless of the fact that even if we know it's going to take a long time to raise, we still need that money. We've still got those bills. We've still got payroll that we're trying to cover. So that frustration bubbles up. The difference is you got to push that stuff down. You got to push that stuff down. And you have to show up in these fundraising meetings as if you are on top of the world. As soon as you show weakness, that is a horrible sign for and that's not the same as being dishonest. That's not the same as having a certain level of humility or vulnerability. It's the idea that if you're not confident about what this company can do, nobody will be confident for you.
And you can tell in the ask slide. I just saw pitch deck yesterday, and the ask was, we are raising $10 million to fulfill on $20 million of contracts in the next 18 months. Like, bang on. You can tell that founder was really pushing it and is selling all the way home during the fundraising process.
We're here to make money, by the way. Okay, so the third step, let's just finish this triad. So again, the first step was just the time it takes to reach out, pitch, contact investors takes a long time. Second part is actually going through diligence, assuming you even get a deal underway. But the third part is the actual close. Now, this is a part I don't think folks understand. The third part is, do you know how long it takes to get all of those attorneys to all agree to the same damn thing? Because let me paint the picture. Typically, you're almost always going to have a number of investors in your round. It's almost unheard of anymore to have a single investor in your round. Okay. So let's say you have 5, which is actually a fairly low number. What folks don't think about when they go into the close process is those are 5 different attorneys. Every one of those investors has their own attorney, their own counsel, their own opinion, their own bias, right? And each of those attorneys is billing by the hour back to their client, making sure their client is taken care of. Now, some of them will be low maintenance, rarely, but what attorney is trying to bill less hours? What attorney is trying to be less of a pain in the ass, right? That guy doesn't exist. In fact, you probably don't want him as your attorney. And so now here's what happens. We've now got to close in this document. And this document has to be shipped around, passed around, CC'd to all of these people over whatever period of time. That is 30 days at a minimum, and that never happens. It's more like 60 days. And then frankly, once all the documents are executed, which is not easy to do, herding cats to the nth degree, you still got to wire that cash. So Ed, let's stack all those timelines. I've got a few months that it's going to take me to reach out to people and talk to them. I can't accelerate that. That's going to go as fast as it can go. I've got at least a month or 2 of diligence where the investors are going to get comfortable. They also agree that everybody else actually is going to invest, et cetera. And then even when I've done all that and everybody's agreed, it's going to take me a couple months just to close. That's 6 months, and you've done everything right.
Let's talk about how this looks in a real life story. Again, member of Startups.com, going through due diligence, got the pitch done, they're interested. Then it's literally been months. Fly here. Let me talk to your customers. I'm going to put you in front of some of my customers.
Right.
And then I'm going to have you meet my associates.
Yep.
And then we're going to do behavioral interviews. You're going to do an assessment all the way to end up with a no. But then our founders say, hey, I downloaded the SAFE document from Y Combinator. That's just going to sign on the dotted line. Everyone's going to get their money, and it should be that easy, shouldn't it?
Yeah. It's never that easy. And again, I think part of it is we don't think from the investor side, right? We think about our own selfish needs, which to some degree we should be, but we don't think about it from the investor side. The investor is most likely going to lose a lot of money on this. So they're in no hurry to find more ways to lose more money. So yes, they're going to drag their feet, because pretty often when they're flipping over all these stones, trying to do diligence, et cetera, they get some pretty awful answers. And if you're an investor, your job is to say no. I know that ultimately the job is to say yes, which is why I would be the world's worst investor, because I can only think about why things will work. I can't say no to anything. And that is not the way an investor works. An investor is there to get themselves out of bad situations. And a good way to be a good investor is to say no an awful lot, as painful as that is.
Let's wrap it up in terms of the timeline. So let's pop the bubble.
Yeah.
Realistically, what are we telling founders right now how to buckle in and what to prepare for if they say they want to raise 500 grand?
Yeah. Here's what I tell you. It's nearly impossible to do in less than 120 days. Nearly impossible. And that's in good times. As of the recording right now, we are in a nuclear winter of funding. That doesn't mean people aren't getting funded, but it's just even harder than it was before. But even if you go back a few years when things were just cranking, it still takes the same amount of time in order to get those deals done. So to be fair, back then, part of what was dragging was there were so many deals getting done that those investors had to manage a lot of things right now. Now there's hardly any deals getting done. But if you are one of those deals, you'll get moved along quicker just because you're not as held up by all the other deals.
And the market's just not frothy enough to have that FOMO where they want to move any quicker whatsoever.
Yeah, you don't have to move quicker. And by the way, if you're an investor, generally speaking, being forced to move quicker doesn't yield better decisions. Being forced to move quicker means that you get forced into deals at higher valuations with less diligence, and you end up losing more money as a consequence in many cases. So for the investors, it's in their nature to try to hold things up to an extent, to try to hold things up, to be prudent, which they should be.